Hello and welcome to another edition of Arrow Insights. I'm Simon Lewis and I'm joined by my colleague Ryan Synnot. Today we're talking about asset class diversification within clients' portfolios. Welcome, Ryan.
Thanks for having me, Simon. Today's an important topic, one that's applicable to both beginner investors all the way through to seasoned professionals.
Absolutely, Ryan. Diversification isn't just about spreading your investments, it's about strategically balancing risk and return. Let's kick things off by discussing risk, return, and diversification.
Yeah, sure, Simon. So at Arrow, we diversify our assets across a range of asset classes. Specifically, we have divided our universe into 8: Australian equities, international equities, property, infrastructure, alternatives, enhanced income, and cash. And we believe that each of these asset classes offers their own unique risks and return profile for investors. So by spreading an investment portfolio across these assets, we expect them to deliver at different points in time for our clients.
That makes sense, Ryan, and it ties into the concept of risk and return. Different assets come with different levels of risk or volatility and also different levels of return.
That's correct. So your higher risk investments such as stocks are often subject to a higher level of volatility, whereas your lower risk investments such as cash and bonds are often much more stable. There are some assets, such as property, that lie somewhere in the middle, a good balance between risk and return.
And those assets have different types of risk too, don't they? So it's not just volatility, for instance, but there are different risks that impact different assets at different times.
That's correct. So within equities, there may be company-specific risks, market risks, and then in different asset classes such as bonds, you're exposed to interest rate risk as well as credit risk. So there's a wide range of factors that impact an investment portfolio, and it's important to be aware of these risks at different points in time.
So Ryan, it's about finding the right balance so that clients can meet their goals and objectives, but also so that the portfolio is aligned with their risk tolerance.
That's correct, Simon. So as a portfolio's level of risk increases, as does the expected return on that portfolio. However, at particular points in time, it may be subject to deeper drawdowns relative to a more defensive approach. Depending on a client's goals and objectives, we can work out what level of risk is appropriate to meet those goals over a longer term horizon. And the benefits of a diversified investment portfolio results in the investor not having to rely on all the assets performing at a particular point in time.
Thanks for that overview, Ryan. Let's also discuss the long-term benefits of a diversified portfolio for our clients.
Yeah, sure, Simon. So we know that not every asset class is going to perform at the same point in time. There'll be some asset classes that may perform well in one year and others that perform poorly in another. By having a diversified portfolio, what we're trying to do is introduce a number of sources of return, and ideally over a long-term horizon, this results in a portfolio with a much smoother return profile and subjects an investor to lower volatility.
So investors should also achieve better returns over the longer term, but possibly with less volatility in their portfolio by being more diversified.
That's correct.
It is also about achieving more stable and potentially higher returns over time. And our clients should have peace of mind knowing that they are working towards their goals with a more balanced portfolio and achieving more consistent returns from that asset allocation. Ryan, another area that we'd like to discuss is how the investment committee goes about making asset allocations and also changing the portfolios based on valuations of different asset classes at any particular point in time. Can you please discuss this a little further?
Yeah, no worries, Simon. So each investor will have an assigned level of risk based on their objectives, and then based on that level of risk, there is an associated asset allocation benchmark. The investment committee may rebalance a portfolio. At particular points in time, some asset classes may perform very, very well and drift overweight within a portfolio, and the committee may elect to pull that allocation back. On the other hand, some assets may be underperforming or go through a period of drawdown, and at that point in time, the investment committee may look to top those allocations back up. In addition to that, the investment committee may take a particular view on a given asset class. If defensive investments, for example, are generating an attractive all-in return or an attractive yield, the investment committee may elect to reduce some of the higher risk investments in that portfolio and reallocate to the more defensive investments. In addition to that, the investment committee may look to capitalise on periods of volatility or sharp drawdowns within equity markets, and may look to deploy some defensive investments into the riskier parts of the portfolio.
The investment committee certainly plays an important role in ensuring that our clients meet their goals and objectives. Thanks, Ryan, for your insights today. Thank you for listening in to another episode of Arrow Insights. We look forward to you joining us for the next episode.